Hello everyone and welcome back to Magno Investments. Today we are going to analyze another company. As you can see, we are here on the Substack. I will put the link on the description as usual. And today we are going to analyze the LDC group. This is a French company. This company is a small cap business. This is another thesis from European small cap business. And the interesting thing about this company is that I saw it like 3 years ago, and I did not invest on it, and I regret because they had a really good performance. Well, first of all, remember this is not an investment recommendation, and it should not be considered as any advice. Okay, everyone has to do their own research. Well, as I was saying, LDC is a food company. Okay, this small cap business, and it has more than 100 years. Okay, they have been doing this for more than 1 century. This is a familiar business, and they started from a local poultry business, and they have become one of the largest convenience food platforms in Europe. We'll take a brief look to the company, and then we will move forward to the valuation as usual. Regarding the sector analysis about the poultry business or the food sector in Europe, we have to mention that it is quite resilient. Okay, this is a quite stable business model as well, because basically this model is not like rocket science, right? It's quite stable because also the consumption and the demand of its products, okay, are quite stable, quite steady. And as we can see, for poultry business globally, we can expect like 3 up to 2% of growth. Here I put some extra files, some extra research. In this case, it is from Europe, okay, and they say that the consumption from poultry is not expected to decline. It is not expected to slow down as compared with other kind of food or other kind of meats. The thing is, the consumption of food, or in this case the poultry, is non-discretionary, okay, and it's gradually expanding, okay. The thing is, as they mentioned here, is expected to grow, for instance, in this case, 1%. Okay, this research says that. And what can expect from this company, right? The thing is, population can grow to 1-2%, and they have pricing power because again it's non-discretionary, and they have a strong brand, as we can see below. We will see below, sorry. And through this organic growth, 1-2%, this pricing power, 1-2% extra, and also the acquisitions. Also, we will see below how they acquired local business to reach more total addressable market and expand the company. We can expect from these inorganic acquisitions like 4-5%, which gave us a total growth of 8-9%, which is the performance of the company in the past, and also is the projections of the company that they have been doing for the future. Okay, but how it works? Well, LDC operations are spread across more than 100 industrial sites in Europe, and as we can see here, and they are mainly based on France and Belgium, but also they have exposure. There are also facilities on Poland and Hungary. The interesting thing about this business model, is that they have a huge scale, okay, and this is very important thing because they control all the supply chain. I mean, they have their own factories, their own farms, they raise the chickens, and they are also involved on the packaging, the branding. They have their own trucks, so they control all the process of the quality process until the product reach the supermarket. This fact allows them to reduce logistic costs because again they are the owners of the trucks, or at least most of them, and also the freshness of the products, because as we saw here, they have acquired some local brands for instance, from Poland. So they have their facilities there. So the logistics times reduce a lot the friction, and they can serve a good product, a quality one, and also quite fresh because they are close to the final customer. What entails is that they have a huge scale, as I said, and it's very difficult for the competence to compete with them. Here we have what I just said about the supply chain and the control of the process. They have the control of almost everything, so they can be more efficient as they can reduce some cost and also check the quality of the product. Basically, the companies divide in three main areas. And the first segment will be the poultry in France, which accounts almost the 70% of the group revenues. And it's made by the local brands, very well known local brands. And basically it's the core of the business because almost all the revenues comes from it, and allows them to pay a dividend, purchase another companies, or repurchase even their own stock. Secondly, we have the catering, which is made by the different ready meals they serve to stores and supermarkets, and it is expanding, and now it weighs almost the 18% of the revenues. And finally, we have the export division, which entails the different local brands we saw on the map, that they have acquired in different countries, and the consumer relies on them. Regarding the profile, we have to say that it's quite good. And I would like to highlight that they have a net cash position, approximately of 70 millions of euros. And also they have a really good ROIC, right? They also, as mentioned at the beginning, growth on a stable basis of 8, 9, up 2%. And the thing is that they have a really good M&A division because they have acquired the business really low. If you do the math, you can see that they have acquired the different business from different countries from 6 up 7 or 8 times EBIT, which is quite good from my point of view. Finally, we are going to move to the valuation. Again, remember, this is just an illustrative example, okay, and you should not take it as any advice or investment recommendation. I put here some screenshots, okay, but we are going to move to the Excel. As you know, the Excel works very simple. I have to fulfill all the gaps in gray. On the other data is basically fulfilled with formulas. So I only have to change the gaps on gray. I have assumed a 9% of growth, which is the average, as I mentioned. A margin EBIT of 5%, which is the average also of what they have been doing, and a tax rate of 20%. And also I have maintained all the shares quite stable. Okay, I have reduced them slightly the last years, but it's basically what they have now. This is the free cash flow. The thing is that this company has a lot of capex expenditure. That's true. That's the only thing that I don't like, but it's the nature of the business, right? And they have to manage a lot of plant and equipment. They have warehouses, they have factories, so that's what it is. You can change it. This is the balance sheet, okay? This is the ROIC in green, again, quite good. And finally, the valuation. Well, the company now is trading at 94 euros. I remain the net cash position stable through the time, okay? It's like, as I said, 70 millions or approximately. And well, as you know, here we have the projections of the multiples. This company, as I just said, personally, I don't see this company be valued at free cash flow because of the capex they have. So the PER, the EBITDA and the EBIT, I think that would be a good proxy, right? This is the dividend that I have had, and this is the returns or the expected returns based on this data, which is public. You can go to the company files or gather this information from some websites. Okay, and this is the range of the performance of the returns that these multiples, which are also the average multiples that the company has, or the peers, right, the other companies which are similar can have in this sector, in this field. And this is the prices, okay, and the returns that this example gave me. If we move to do the free cash flow discount, it gives us a price of 108 euros, which are upside of 13%. Here are the maths, okay. I have assumed this EPS, okay, from this last year. And also this is the expected growth, 2%, and the terminal growth I put 1%, and this is the WACC, okay, in red. Again, the free cash flow discount, I don't like it too much because it's quite sensible. The people who are involved in analyzing equities knows about it, because if you touch just one of the variables, this price can vary a lot. So as you know, I do 3 different valuation methods. This is the multiple one. This is the discount model. And also I like to do a beta projection with different scenarios, okay? What I did here is to project the EBITDA in the future. And I add this EBITDA a multiple of 7. I add the different free cash flows. I discounted it to the present with this current WACC, okay, here in red. And finally, I divided basically by the shares that the company has. So it gave me a price of 112 euros, which is quite close to the last one. And moreover, and this is the end finally, what I do is basically project this EBITDA multiple valuation with different EBITDA multiple exits, and also different WACCs, okay? And also I do the same with the free cash flow. This is the 534. This is the EPS from here, okay? And I assume different terminal growths, okay, 1%, 1.5, and different WACCs. But I like to do it in this way because it gives us a really range and a really good valuation or fair value that the company could have, right? Because here it's quite static, and you can rely on this this kind of valuations. But I like and I prefer to do this because this a wide range of prices that the company could have, right, to be fair valued. And just to mention also, the valuation by free cash flow gave me a 108 euros. And if you go to some websites like Market Screener or Investing, we can see that the different analysts here, in this case, is covered by 5 analysts, are also on consensus that the company could be valued at 107 euros. And in the case of Investing, the company could be worth of 108 euros. So I'm close, right? I'm close. But again, I prefer to do these scenarios because I think that it could be even more accurate. And well, that will be all. I hope you have enjoyed. I hope you have learned something, and see you in the next video. Made Investment be with you.